Welcome to the Daily Update Podcast, where I'll go over the action in the market for Wednesday, September 17th, and we'll see how things look for Thursday, September 18th. The Federal Reserve's widely anticipated 25 basis point rate cut sparked a volatile session on Wall Street. The S&P 500 opened flat, dipped below its first support level at 65.96, rallied above the first resistance level at 66.22 after the Fed's announcement, then fell to the second support level at 65.84, hitting an intraday low at the 65.50 level. By the close, it settled near 6,600, down just 0.1%, virtually unchanged, but technically a down day. Trading volume was slightly above average, reflecting heightened activity. Despite the swings, the S&P 500 remains above its 20, 50, and 200-day moving averages, signaling a positive trend across all time frames. However, the intraday volatility underscored emotional reactions to the Fed's decision rather than calculated moves. The Fed's rate cut was no surprise, but the FOMC is split on what's next. 9 of the 19 members project one more rate cut in 2025, 10 expect 2 rate cuts, and 1 anticipates no more rate cuts in 2025. The markets, however, are pricing in cuts for both October and December, finishing out 2025, with another projected for 2026. Inflation remains sticky at around the 3% level, above the Fed's 2% target, with tariffs cited as a short-term driver. On the economic front, housing starts rose 8.5% month over month to an annualized rate of 1.307 million, which was below expectations. Building permits fell 3.7% to 1.312 million, also below forecasts. Meanwhile, the weekly mortgage applications index surged 29.7%, fueled by a 57.7% jump in refinancing, as the 10-year Treasury yield has been hovering closer to 4%. The dollar strengthened in Wednesday's session and yields rose to 4.08%, still at the lower end of the recent range. Looking at market indicators and sentiment, short-term indicators including the Stochk RSI and CCI charts show slight weakness but still lean positive. Intermediate-term indicators are mixed, with some showing strength and others softening. The S&P 500 is trading in the +3 standard deviations channel, but is significantly above its 50-day moving average. It's also more than 10% above its 200-day moving average, a level that has historically preceded pullbacks in both 2023 and 2024. Market sentiment dipped slightly from 58 to 57, but remains positive. The VIX is still below 20, indicating lower volatility. Advanced decline ratios and accumulation distributions suggest short-term weakness but overall positive, with momentum oscillators including the MACD and PMO continuing to look more positive. Going through the sectors and stock highlights, the financials led the day, followed by staples and communication. Nvidia, however, slid 2.62% amid reports of China discouraging domestic purchases of its product. The Dow touched an intraday all-time high. The Nasdaq declined, while small and mid-cap indexes, including the Russell 2000, closed well off of their highs, showing neutral momentum. Looking ahead to Thursday, September 18th, the S&P 500's positive trend persists. Key levels to watch include the 20-period moving averages for potential declines, and can the S&P close above or below the 6,600 level. The economic calendar for Thursday includes initial as well as continuing jobless claims, the Philadelphia Fed Index, and the leading economic index. Seasonally, September 18th has a neutral to negative bias for the S&P and Nasdaq, with options expiration week historically mixed, up 55% of the time, down 45% of the time, and the second half of September is typically weak, but has yet to materialize in 2025. Thursday's market danced to the Fed's tune, with volatility driven by rate cuts, but little net change by the close. The S&P 500's positive trend holds across all time frames, but softening short-term momentum and an extended position above the 200-day moving average suggest potential pullbacks may occur in the near future. Seasonal weakness could also play a role. Thank you very much, and I will talk to you in the next podcast.